Hey, this is Miles and welcome back to my channel. Today we're talking about forbearance. I'm sure you've seen the word circulated all over the media, but if you're struggling to make a payment and you're late, there are only 4 real actions you can take before you enter into the foreclosure or short sale process. 1 being a reinstatement, 2 being a repayment plan, 3 being a modification, and last one, our topic for today, is a forbearance. We're going to get to the first 3 options a little later in the video, but first let's talk about forbearance. We're going to talk about what it is, whether you should do it, and what it means in the overall bigger picture in the economy. If you're new to the channel, we're going to be talking about all things real estate related with economic news sprinkled in. I'm Miles. I've been in business banking, done some commercial loans. Currently, I'm a residential loan officer. I have a fair amount of mortgages myself, and I've called each and every one of them to actually get the data on what they're offering and what it's looking like today. So with that out of the way, let's get it. If you're a homeowner, forbearance is something you should at least have thought about once during this coronavirus pandemic. Before we get into whether it's a good idea, let's talk about what it is. Forbearance is a temporary postponement of mortgage payments. It's a form of repayment relief granted by a bank instead of forcing a property into foreclosure or short sale. Loan owners and those loan insurers may be willing to negotiate forbearance options because the losses generated by the property typically fall on them and are greater than the loss otherwise. So what's this actually mean? It means banks would rather work with you than have to take over a property to sell it themselves. Let's remember, these are bankers. They're not real estate agents. In just one day on April 1st, the giant servicer Caliber Home Loans reported 8,000 forbearance requests, and Black Knight, as of April 10th, reported about 2.9 million people have entered into forbearance, or 5.5% of all mortgages out there. We should probably assume that there are way more requests now than there were then, and these are going to continue to grow. But can you imagine a bank foreclosing on that many loans all at once? That would be chaos. It would cost the bank billions of dollars because they're maintaining properties where they're not collecting any money. Does this sound familiar? Wait, let's take a step back to 2008, 9, and 10, where we saw millions of foreclosures going on throughout the country. At that time, banks couldn't handle all the foreclosures at once, so people were living in their homes for years, not paying anything until the banks got them out. Banks also didn't want to release the properties all at once and flood the market with below market properties. So they released them in waves, not only buying themselves time, but by doing this, they also save themselves money over time because properties started to increase over the years and thus their losses weren't as great. Long story short, it's way more advantageous for banks to work with clients on forbearances rather than foreclosures. So why is forbearance everywhere in the news with so many people having applied for it? Well, obviously, as of this date, coronavirus has hit our economy like a ton of bricks. This is single-handedly the biggest impact. Another reason is that it's fairly easy to apply for because you don't really need to prove any hardship. You can tell them you've been affected and they'll send you the paperwork on the spot. Also, you can pretty much have no payments for up to a year with no interest accruing on it. However, there's a misconception out there that if you don't make 12 months payments, they'll just tack it on to the end of the loan, essentially extending your loan term by a year, which is so far from the truth. I've heard many people out there who aren't really talking about this as much and aren't talking about the repercussions and unintended consequences of it. So let's look at an example of what a forbearance actually looks like. Now remember, there is a difference between forbearance and deferral. Let's pretend that your current monthly payment of principal and interest is $2,026 a month with a $450,000 loan amount. Now, when you typically call them, they're going to tell you can take out a 3-month forbearance. And you can ask for more later, essentially suggesting that if you're still affected, you'll be able to push back this time at least a year. Assuming you tell Mr. Banker you'll need till the end of 2020 for forbearance, that means your first payment would be January 1st, 2021. That means you'll be behind 7 months, which is $14,182. So for your January payment, you're going to need about $16,208 because of January's payment. More than half the loans out there have what we call an impound account, which means you're paying property taxes and homeowners insurance and the monthly mortgage payment. In my state of California, they have not delayed yet or forgiven property tax payments. And the state not collecting their money is probably a long shot. Everybody's looking for money. I've also not heard one thing about homeowners insurance being forgiven or payments being pushed back. So let's also assume that this is also going to be due. Now in our example, let's say the house is worth $600,000. You're probably paying property taxes of 7 months around $625 a month or $4,375. Homeowners insurance at the end of the forbearance period, we could estimate is going to be around $700, which is $100 a month. And that's an estimate here in California. Obviously, every state's going to be different. But assuming these numbers, you're looking around $22,008 that you have to make a payment in January. The property taxes and insurance is something no one is really talking about. The principal and interest payments are one thing, but factoring your impound account makes this a whole different beast. And we really need to figure out whether it makes sense to sign up for this. Assuming you complete your forbearance period after that 7 months, what's going to happen to the amount that you owe and if you can't pay it? That has remained vague, with every lender handling this a little differently. However, our 3 options from before will most likely be available. That's reinstatement, repayment, modification. So reinstatement, it's pretty easy to understand. You make one lump sum payment to bring yourself current. Option 2, repayment plan. They take the amount that you owe. In this case, it could be $22,000, could be $16,000, and they add it to your payments over time. Let's assume in our example that you paid your taxes and insurance on your own. You paid it separate. So your only payment per month is $2,026. If that past due amount is extended over just 1 year, and we broke that $14,182 into 12 months, we'd add another $1,181 to our payment, which would make it $3,207. If they broke it out over 2 years, your payment would increase to $2,616. So we need to figure out whether this is actually affordable for us once this forbearance period's over. Lastly, we have a modification, which I think is going to be probably the way most people go. Modification is a form of derogatory credit. That means we don't look at it very kindly when you try to come back and get a mortgage. But there are many types of modifications. I've seen them in one lump sum that you owe and you're only paying interest on some of it, the reamortization of a new loan, they forgive the debt, which in the lender's eyes is a short sale, or even I have seen the tiered system where they have 2%, 3%, 4% over 2 or 3 years, and then it's 5% for the remainder of the life of the loan. There are so many different routes they can go. Each lender's a little bit different and they handle it differently depending on how much you actually make. On our side and the mortgage side, I've already seen guidelines to say that there's any hint of a forbearance that we won't be able to refinance you until this is brought current. Or you take the money and we do some sort of cash out or handle the money differently. So loans are becoming very, very difficult, and forbearances are one of the main culprits for this. I mean, think about it. If you're a note holder on one of these loans, which means if I give money to the bank to lend to you, somewhere down the line, I'm going to want my money. If I keep hearing that more and more loans are going into forbearance, why the hell would I invest in this type of investment? I'm probably thinking I won't get paid back, which is why they only want A+ buyers and borrowers. This is another topic for another video because it's going down the rabbit hole, but if you want to hear more about the internal workings of mortgages and what's happening as of today, please put a comment down below. This video is not to dissuade anyone from getting forbearance. If you have been hit really badly by what's going on in the world, then this is something you should absolutely consider. You know, if you've lost your job for a reason you can't control because everything stopped, it doesn't mean you're a bad borrower. So this should be at least an option that you have. However, it is important to weigh whether it's going to be good for you down the line, whether you want to tie yourself into this financially. There is much that is going to come out regarding forbearances, but I will tell you that we probably won't see the effects until this pandemic is not only over, but when that forbearance period ends is when we're going to hear more and more about it. Inevitably, there are people out there who are going to take advantage of this, so we want to educate as many people as possible because this only affects you if you're trying to buy another house, you trying to buy a new house, because it is going to be much harder to get it down the line. Thanks for watching my video, and if you enjoyed the content and found it of value, please smash the like button below, and I'll see you next time.